let's talk a little bit about disposing of accounts receivable and notes receivable. And what does disposing of them mean? Well, ideally, in a perfect world, you would dispose of them by just collecting on them, right? You would just collect your cash that is owed to you, but that's not always the case. Now, this chart, this isn't necessarily something you need to know super well. It's something I actually cover in FAR as well, but it does come up on this exam. And just like if you're trying to understand another language, right, you're not going to get the full picture if you don't understand what these are. Are you going to get direct questions on these? It's possible, but I would just be more familiar with it as a whole. All right, so other than collecting on these receivables, right? I mean, again, ideally, like you would like to collect on them, but let's say you don't. You can either factor through secured borrowing or sell your receivables. And this is both with third parties. So you can, let's say it's you're a company. This is your company, and there's a third party. This is a company that literally does this. They do this for a living. They factor receivables, and they buy receivables. What you could do is secured borrowing. Let's say you have $100,000 of receivables. Well, since you're not getting cash from those right away, you want to manage your working capital, right? That's the goal here, is to be efficient with your assets, minimize your liabilities. And what you could do is, just like with a mortgage, if you don't pay it back, the bank takes your house, and that's collateralizing. You're using an asset to get a cheaper loan, just like a home equity line of credit or refinancing. So too, can you factor your accounts receivable or your investments or anything? But we're focused on accounts receivable, notes receivable here. Maybe because you pledge your receivables, you'll get a 2% loan, which is pretty cheap. Now, in this company, right, they give you the cash up front. You pay them, say, 2% a year. And if you don't pay them back, they can take all of your receivables. So they have the right to your receivables then. It means then they have to then go and collect. So when you just do this process, the holder retains ownership of receivables. So you own your own receivables. Obviously, if you don't pay the interest on this, then then the third party takes control of the factor takes control of your receivables. The original company, so you as your company, you still maintain risk of collecting the receivables. The transferred assets are not isolated from the transferor. You still maintain your assets. Transferee does not have the right to pledge or sell them, so the third party cannot sell your receivables or pledge them or do anything with them. And the transferor has not divested itself of control through repurchase agreement. Again, you still have ownership and control of your own receivable. Now, what if you sell your receivables? Now, why would any party do this? What would happen here is, let's say you are owed $100,000 from your customers. You would then sell your receivables to this third party, and they could buy it for cheaper, right? They would say, okay, we're only going to give you 70% of what is owed to you, and maybe you just want the cash today. All right, so what they do is they give you 70,000 in cash. They now the receivable ownership transfers to the third party, but you get 70 in cash, and you're done. It's nice and easy for the company because you just, right, you don't have to worry about it anymore. You got your cash. It's not the full amount, but you got your cash. And these third party companies are generally, these factors are super efficient, right? They're like collection agencies. They're great at collecting receivables from those who it is owed to. So they're much better at it. Let's say you're just a simple manufacturer. You're not good at going door to door and trying to, phone calls and collecting receivables. Well, maybe this makes more sense for both parties, because now the third party, the collection agency, owns the right to this 100,000, and right, they're super efficient. The buyer of them assumes the risk of collection. They go to those customers and say, "Hey, you better pay up, or we're gonna do a little mob action. We're gonna break your kneecaps." It's a little graphic. No, they do it completely legally and PG. So ideally, the third party wants to get the full 100, right? But it takes them time. It takes them effort to go collect that 100,000. They now have a profit margin of 30,000. Same deal. We transfer ownerships, transfer assets. They're transferred. They now belong to the collection agency. The transferee has the right to pledge or sell these assets, and the original company has gotten rid of all of its control over these through a repurchase agreement. So this is a factor, again, collateralized loan. You think of this similar to that home example with a mortgage. So you can buy the receivables at a discount. All of these are valid options. Just, well, how does this fit in again? Well, this is because you can manage your short-term receivables, your short-term assets much more efficiently. And these are just other options. You don't have to take these options, but these are options as a company that you have. Well, we talked about factoring. We talked about what a company would do with their receivables. Let's see an example of what this situation could look like. Now, obviously, in this situation, it's going to have a little bit more components to just than just the description I gave you. We're going to see this in real time. We're going to see this, what you'd have to do mathematically wise. And this is a situation where you're selling your accounts receivable to a factoring, right? We are Twill Company, and we are selling our receivables to FTX Factoring Inc. Question is going to ask, what is the annual cost of financing, assuming a 360-day year? This is a, let's say, customized situation. We've got some components of factoring, some components of selling the receivables, and you just kind of read the agreement, read through the information, and see what these two entities agreed upon, and then what's the cost of this for Twill. That's all it is. And well, as we mentioned, what's a cost? That's going to be our outflows and inflows, right? Think back to every time I mention that, right? Outflows, inflows, inflows, outflows. Someone's cost is someone else's return. Let's take a look and see. Okay, we signed an agreement that FTX is going to factor Twill's accounts receivable. So FTX is the third-party factoring or collection agency. FTX agrees to buy Twill's accounts receivable, and we've got an average accounts receivable of about $100,000 per month. We have an average collection period of 30 days, meaning, right, we have about $100,000 per month of receivables. It takes us 30 days to collect them on average, which is pretty good. It's pretty solid, I would say. FTX will advance up to 85% of the value of the receivables at an annual rate of 12%. Here's a 12% fee for advancing 85% of the receivables. And then there's a charge fee of 2% on all the receivables purchased. Twill's controller, Twill's a company, decides and estimates that the company would save $15,000 in collection expenses over the year, right? As I mentioned, Twill is probably a manufacturing company or just some normal company, and they don't specialize in collecting receivables. They specialize in making a product or performing a service. As such, by giving the receivables to a specialized entity, they would probably save in collection expenses. That's pretty fair. Fees and interest are not deducted in advance. What is the annual cost of financing, assuming a 360-day year? Let's start with, well, what's our receivable balance? Okay, we have $100,000 of receivables, $100,000 of receivables, and first we just have a straight flat fee of 2%. So 2%, $100,000, but this is monthly AR, keep in mind. As such, 360 days, we have a 360-day year. On average, we collect them 30 days. This gets you 12, so 12 months. 100,000 times 2% is 2,000. 2,000 times 12 gives you $24,000. This is the balance of our subtotals right here. Now, what is the amount subject to interest? You're only going to pay interest on, and this is from Twill's perspective, right, on the amount that is actually advanced. And what is advanced? Well, 85% is advanced. You're not going to pay interest on what is not advanced. You're only getting 85,000, 12%, and we've got 12 months. 12%, so this is 1% a month. But really what we're saying here, this is just breaking it down, right? It's 1% a month, but we're still doing annual amounts. We're doing the annual cost of financing. That's what we're looking for in the end. So as such, this is, again, breaking it out, saying it's 1% a year times 12 periods, which a period is just a month, gets us back to 12%. I know that if that seems redundant, it's just to break it out, because what if it wasn't as clean as what we're seeing here? That might be the case. Well, we do 12% of 85, gets us $10,200. This is the cost to the company of this $85,000 face value upfront for 12%. All right, great. So far, let's just recap. we've got a $10,200 fee of what was upfront given to Twill. We also have this base 2% fee on everything. As such, total fees so far are $34,200. Right. So just to recap again, it is a lot, and I understand that, so I'm just going to talk about it. We pay 2% on everything, all receivables purchased. All these were purchased, and FTX advances 85%. You paid just 12% on the advanced receivables. That's how we get our total cost to the company so far of $34,200. However, as we say, we're going to save $15,000 in collection expenses. So we're going to deduct that from the costs because we're saving this. We're actually saving this money, giving us a net cost of $19,200. And this is our net cost, right? So this is our outflows divided by inflows. We want to do that. That's the cost for anything, is outflows divided by inflows, or some variation of it, but that's the general gist of how to calculate the cost. As such, we are receiving 85, we're paying net 19,200. That gives us 22.59%. And I would say this is a high cost of borrowing. That's a pretty high interest rate to borrow money. It's the effective interest rate because we're taking into account all the components, right? We've talked about effective interest rates. These are really just actual interest rates, right? What's actually happening. Maybe this is not worth it for Twill. Maybe it is. That would be up for Twill to decide. A sim might give you another possibility of what you could do, and you have to decide between both options. Obviously, you choose the option that is cheaper. Well, this is a good old example of factoring receivables. What would you do with that? You want to manage that working capital to make sure that you're able to pay down your debts, that you have enough cash, all right, and you're managing it well.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.